Imagine this. You've got $500 in your account and you want to get into the stock market. But the thought of picking individual stocks makes your head spin. Here's the thing. You don't need to be a stock-picking genius to own the market. The easiest, most powerful way is usually an index fund, a simple plan that most people ignore. Hey, I'm Jay. I spend a lot of time thinking about practical finance, building wealth, and figuring out how to make money work for you instead of the other way around. Today, I'll break down what an index fund really is, why people get it wrong, how to pick one that fits your goals, how to buy, sell, and reinvest, and the homework you should do before you click buy. No stock tips here, just how to evaluate your options so you can make smart choices and start growing your money. In simple terms, an index fund is like a bundle of stocks that tracks a whole market, like the S&P 500 in the US or ASX 200 in Australia. It owns all the companies in that index in roughly the same proportion. Why it matters? Instead of betting on one company, you own a slice of hundreds. That gives instant diversification and usually way lower fees than trying to pick stocks yourself. Truth is, being average of the market is exactly what beats most professional investors after fees over long periods. If you invested in an S&P 500 index fund 20 years ago, you'd automatically own part of Apple, Microsoft, Amazon, and more. No stock picking needed. That's the power of compounding over time. Now let's talk about the different types of index funds and what you need to watch for. First up, ETFs, or exchange-traded funds. ETFs trade like stocks during the day. Some brokers let you buy fractional shares, and prices update constantly throughout the day. Then there are index mutual funds. These are bought with a set dollar amount, priced at the end of the day, and are often used for automatic monthly contributions. You also need to look at exposure types, broad market like the total market or S&P 500, domestic versus international, or even sector-specific funds like tech or healthcare. There are key differences to check. Most importantly, the expense ratio. Remember, lower is better. Also, look at tracking error, how closely the fund follows its index. Don't forget tax efficiency, especially if you're reinvesting dividends, and the index methodology. Understand exactly what companies are included. Let's look at some popular ETFs. SPY and VOO both track the 500 biggest US companies. SPY is very liquid, while VOO is great for retirement accounts due to lower costs. VTI tracks almost all US stocks, giving you more diversification. On the flip side, EEM covers emerging markets. It's more volatile, but can offer higher growth. To check risk, look at beta. A beta of 1 means it moves with the market. Greater than 1 means it's more volatile, and less than 1 means it's less volatile. Correlation shows how closely the ETF tracks its index. You want it closer to 1 for better tracking. Also, always check the 5, 10, or 20-year total returns. Ready to start? Here's how to buy and sell an index fund, step by step. First, decide your vehicle, ETF for trading flexibility, or mutual fund for automatic investing. Open an account with a broker or platform that offers the fund you want. Then, do the math. If you have $1,000 and the ETF price is $200, you buy 5 shares. Place your order, a market or limit order for ETFs. Then set your dividends to automatic reinvestment or DRIP. Reinvesting is what compounds your returns. Let's talk psychology. Many people chase hot sectors or past winners, but discipline and low-cost investing are the real keys to long-term success. There are risks. Index funds follow the market. If the market drops, your fund drops. Also check concentration. The top 10 stocks in the S&P 500 make up about 30% of the fund. Before you buy, do your homework. Check the expense ratio, read the fund fact sheet, understand the methodology, and confirm the tax treatment in your country. For example, contribute $200 a month to a broad market ETF, enable DRIP, and let dollar cost averaging and compounding do the work for you. Keep it simple. Do your homework. Automate the habit and let time and consistency grow your wealth. Small steps today lead to big wins tomorrow. Like and subscribe to Infinite Wealth Education. Comment on what you want next, ETFs versus mutual funds, or a simple 3-fund portfolio. Keep growing your wealth.